Hi, guys. Today we're going to be looking at three different accounts. You had your asset accounts, your liability accounts, and your owner's equity accounts. Today we're going to look at revenues, expenses, and withdrawals. And you will have some practice problems to do with this. So, we're going to look at what's called temporary accounts. So, we have temporary accounts today that we're looking at. Temporary accounts and permanent accounts are our keywords. Temporary accounts are revenues, expenses, and withdrawals. These are all accounts that affect owner's equity. So we put them in a temporary spot for an accounting period. So if I do my accounting based on a month, then I use my revenue, my expenses, and my withdrawals for that month. And then at the end of the month, I record a zero balance in them. So I do some transactions to zero them out, and the balance of these accounts gets rolled into owner's equity. So we're going to do our temporary accounts, revenue, expenses, and withdrawals. Those are your three account categories. Revenue is the money that businesses earn by doing their business. So if I have a dog walking business and I walk a dog, I've earned revenue for doing that. Expenses are the expenses of doing business. This does not include loans. Those are those payables that we were dealing with yesterday. Those are liabilities. We're looking at expenses that we pay month after month after month, like my Wi-Fi bill, my electric bill, my rent, my salaries. Those are all going to be expenses. And then withdrawals is a special kind of an account when the owner takes money out of the business, takes an asset out of the business. We're going to use this withdrawal account. So they always start with a zero balance, and then they accumulate for one accounting period, so for 1 month, and then we transfer those balances over to owner's equity. Permanent accounts were the ones that we were dealing with yesterday. This is your assets, your liabilities, and your owner's equity. These accounts, we continue to use them between accounting periods. So they accumulate from one to the other. Because if we have assets, they don't go away at the end of the accounting period. We gain more assets, or we keep the assets that we have. So when we look at our owner's equity account, a capital account, we're going to decrease it with a debit. We're going to increase it with a credit. So we should always have a credit balance in this kind of account. Your temporary accounts affect this, so we follow a lot of the same rules. So a revenue account is going to increase our owner's equity. So we're going to increase it using a credit. It's like we're increasing our owner's equity. We're going to decrease it using a debit. So it has a normal balance on the credit side. So this is what it would look like. Fees would be an example of a revenue account. So the fees would accrue in the credit side. For an expense, expenses are going to decrease owner's equity. So we're going to follow the rules as if we were decreasing owner's equity. So if we're going to increase the expense, we're going to use the debit. If we're going to decrease the expense, we're going to use the credit. So if I have a bill like my electric bill and I need to pay it, I'm increasing that bill. My normal balance will be on my debit side. Remember these rules, okay? Write them down. You're going to need them later. So here's what that looks like. I have my permanent account as owner's equity, or the capital account, and my temporary account of expenses is going to decrease this owner's equity account, and my temporary account of revenue is going to increase the owner's equity account. Withdrawals are a special kind of case, but they follow the same rules. We're going to increase it using a debit. We're going to decrease it using a credit because we're taking money away from owner's equity. But we're going to do it in this special account so that we can make sure we're keeping track of it. If an owner takes a lot of money out of the business, that might not be so good for the business. So here's what withdrawals look like. We're going to increase them using debits. We're going to decrease them using credits. So the withdrawals account would look like this, W. Smith, withdrawals. It's the same pattern as W. Smith, capital. They're both considered owner's equity accounts. We're going to increase it with a debit, decrease it with a credit. So here's a quick summary of your rules. And your key term, temporary accounts and permanent accounts. So let's look to see what this will look like. We're going to look at a few different transactions. I'm going to walk you through what they're going to look like and why they look like they do. And then you can use this resource to help you with your assignment today. I have the slides linked, and I also have the textbook pages linked for you, or you can always come back to this. So let's look at transactions. So we're going to use our rules of debits and credits and look at transactions that affect revenue, expenses, and owner's equity. So for this first one, on October 15th, Roadrunner, that's the business, provided delivery services for Sims Corporation. A check for $1,200 was received in full payment. So we got a check, $1,200. That's cash. Checks are the same as cash. And why did we get cash? Well, because we did a service for them. We did our business for them. So we're going to use accounts cash and bank and delivery revenue. Revenue, remember, that's the money that we get when we do our business. So cash and bank is an asset account. The delivery revenue is a revenue account. Always think about what you do to cash. What am I doing to cash? I'm increasing cash. I got cash. I'm increasing cash. So I'm going to debit cash. If I debit cash, I'm going to have that increased. So I'm going to have my debit to cash, and I'm going to increase my delivery revenue. I gained more revenue. That's going to be a credit to delivery revenue. So remember our debit and credit rules. We're increasing cash, so that's going to be a debit. I have to have a matching credit, so that's going to be revenue. And that's what it looks like as a T account. I'm going to increase cash and bank. I'm going to increase delivery revenue. I debit cash and bank. I credit delivery revenue. Remember, debit means left side. Credit means right side. They don't mean adding and subtracting. It just means what side of my column am I on for my T account. Here's another one. Roadrunner mailed a check. Remember, check is the same as cash, for $700 to pay this month's rent. Well, rent is an expense account. So my accounts that I'm going to use, rent expense and cash and bank. Rent expense is an expense account. Cash and bank is an asset. So my rent expense increased by $700. My cash and bank decreased by $700. And I always think, what did I do to cash? I decreased cash, so I'm going to credit cash. That means I have to have a matching debit, so my rent expense must be debited. And my debit and credit rules tell me that, and that's what my T accounts look like. Let's do another one. On October 18th, Beacon Advertising prepared an advertisement for Roadrunner. Roadrunner will pay the $75 fee later. So we didn't actually pay for this yet. We owe somebody some money. So we had an expense, that's advertising, and we owe somebody money, so that's going to be a payable. Accounts payable, Beacon Advertising. Advertising expense is my expense account. Beacon Advertising accounts payable is a liability account. I'm increasing both of them. I increase the expense because I'm gaining more expense, and I'm increasing the payable because I'm gaining the amount of money that I owe to somebody. I'm gaining more debt. So I'm going to increase the expense as a debit for my expense, and I'm going to increase my liability account as my credit. So think about this. I did not pay cash for this. How did I pay for it? I took on debt for it. To increase my debt, that's going to be a credit to debt, credit to the liability. So I have to have a matching debit somewhere. that matching debit is going to go on advertising expense. And that's what the T accounts look like. So we also have this idea of revenue recognition. According to GAAP rules, we have to record revenue on the day that it's earned, not necessarily on the day that we get paid, which is why we have accounts receivable. Accounts receivable is an asset account that tells you that somebody owes us money. It's the opposite of a payable. So in this case, Roadrunner billed City News $1,450 for delivery services. So we did some services for them. They didn't pay us, so we sent them a bill. So we're going to have accounts receivable and delivery revenue as our accounts. Accounts receivable is an asset account. Delivery revenue is a revenue account. So I'm increasing my receivable, and I'm also increasing the amount of revenue that I did. So I'm increasing an asset, I'm increasing my revenue. To increase an asset, I do a debit. So I have to have a matching credit. So that's going to be my delivery revenue. So my asset will be debited. My credit will come from delivery revenue. Here's what my T accounts look like. This is another expense, cash and bank, an expense. I'm going to increase my expense, decrease my cash and bank. So I credit cash and bank. I'm going to debit expense, my T accounts. I'm actually going to skip over this one. I want to show you a withdrawal. So this case, Maria Sanchez wrote a check to withdraw $500 for personal use. So we're going to lose cash and bank. I know that. But I didn't gain anything from this cash and bank. I'm not paying off a bill. I'm not buying new equipment. What I'm directly doing here is affecting owner's equity. So we're going to use the withdrawals account to do that. We're not going to take it from owner's equity. We're going to see later on that we'll close these all out. But we're going to use the withdrawals account. So Maria Sanchez, withdrawals, and cash and bank are my two accounts. The withdrawal account is an owner's equity account. Cash and bank is an asset. We're going to increase the withdrawal because we're increasing the amount that she's withdrawn. And we're going to decrease cash and bank. So that is a debit to the withdrawal and a credit to cash and bank. Remember, if you can always figure out what you're doing to cash, then you have to have a matching one for the other account. And here's what my T accounts will look like. Lastly, you can run a test for the equality of debits and credits. We did this yesterday when we totaled our T accounts, but this just gives it to you in a different form where you list the accounts and you list if they have a debit or a credit balance, and then you total them out. In accounting, a single line means that you're going to add a total. A double line means that that is the final amount. So what I have in my debit column should exactly match what I have in my credit column when I total these. We're not going to work these problems in here. I do want to tell you that you have a problem set to complete. Please re-watch this walkthrough if you need to, but you also have the slides and you have the textbook pages. You guys can do this. Be confident in yourself. And I shall see you guys on Monday. Bye.